Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings, Mustafa. It's great to have you back on the podcast.
Great to be back, Bilal.
Now
I like your podcast a lot.
Thanks, Mustafa. Now let's get straight into it. We recently had the Jackson Hole meeting for all the key Fed personnel. So that gives us an excuse to talk about the Fed and Fed policy. So what's your current view on where we are in the Fed cycle?
I think the Fed will do a November hike. Markets, since the Jackson Hole meeting, markets have actually gradually pricing the November hike. At this point, about 75% probability. We went into the Jackson Hole with something like 40% probability. So market is also getting a little starting to price that. And with Powell's, we didn't expect a huge amount of information in the Powell speech, but it did show a little bit of the bearish, a little bit of a hawkish tone, not much, slight bit of a hawkish tone in his speech, especially when he was talking about there's still some pain and suffering left to be to get to the inflation target, and he really wants to go to the 2% target still, not changing the target anytime soon. So there is a little hawkish tone to this because the market's slowly pricing a November hike. So there is a November hike coming. My own belief is that they will have to hike more later, but this year November is still seems like.
And one of the things, there's been a sort of noticeable shift amongst the Fed, where they now start to talk more about real policy rates, that the real policy rate using some measure of CPI, forward-looking measures of CPI is around 2%. So policy on that simple metric is tight. And then there's some notion of what the neutral rate is, and they say that, current policy rates are above the neutral rate. Do you have thoughts about this shift from nominal to real policy rates and this idea of the neutral rate?
I think there is some discussion lately about this whole targeting a range instead of one single target, and especially a range of CPI between 2 to 3%. Is recently economists like Jason Farman, etc., have been suggesting that the Fed gradually move to that, doesn't have to announce anything, or should for once they get below 2%, then change it to a range target rather than a point target. But this has been an old discussion. I don't think it's anything new. Year after year, decade after decade, there's the range versus point, because inflation forecasting is very hard. A point doesn't really mean anything. It's actually the right thing to do. It's so hard that it's probably not even forecastable. We feel good about throwing out a forecast here and there, but in reality, it's not really forecastable. Of course, some forecasts, we see some forecasts are right, some forecasts are wrong, but on average, you won't find much forecasting ability in terms of point inflation. So, and that makes sense. But Fed's been talking about this type of averages, etc., for a while. Right before this breakout in inflation, there was a lot of discussion about targeting average inflation. Williams had a very technical paper on that from 2018, and in Fed's actually when they revisited their policy framework, Fed had a listening tour in a couple of years ago, and in that they did kind of adopt an average inflation target, and that didn't work out very well for them. So I don't know.
And Mustafa,
I mean,
what about the neutral, the R star conversation? I mean, Jackson Hole, there wasn't really much conversation, if at all, about R star, but people in the market are talking more and more about, has R star gone up? And as a result, that will then mean that the Fed will have to raise rates by more going forward, because the equilibrium rate, the equilibrium growth rate, you could say, is higher than before. Do you have thoughts on that?
R star is an abstract concept, so that's why Powell doesn't like to talk about it, because it's not something you can talk about in an official communication. You see there's a lot of difference in opinion on that. The very modelly types, like Williams recently gave a speech at the Federal Reserve where he said R star still 0.5 and hasn't really changed pre and post COVID. But if you think about just the difference in the fiscal policy, the amount of spending, it without any modeling, it makes sense to believe that the equilibrium real interest rate in the United States have gone up. And if you look at how the real interest rate, now the question is, does that explain all these models that Fed has? I mean, you can come up with a variety of results. So I wouldn't trust any of those model output on R star. And I can come up with any kind of model with some time varying parameter or all sorts of parameterization. But reality is that the real rates have moved up. And most of the rate moves that we have been seeing since late last year has been real rate moves, because the break-evens have been fairly constant. And so the question is, did the real rates move because the equilibrium real rate has gone up? Or it's just which is equivalent to saying that the Fed will stay at these high rate levels for a long time, because that's basically how the equilibrium real rates would be implemented in reality. It's possible. Couple of reasons. One of them is, of course, the fiscal spending has been really large that we already have observed, but we also have in the future, there are geopolitical events that are anticipated that could push inflation much higher than we have today. If you listen to the Biden administration's industrial policy outlook, moving a lot of production within the US or nearshoring, it means a lot of spending within US and a lot of construction. We see that right now in the industrial construction activities. That data is shooting up, but it can expand in other sectors of the economy. So I think that just the geopolitics, nearshoring, onshoring, etc., tells me that long-term equilibrium interest rate should be higher in the US, not necessarily elsewhere. That's one. The other thing that's very interesting is that if you look at your Eurozone versus US and look at the real rate differential in 10-year, for example, that differential is a sort of a regime change. It used to be 50-ish basis points differential between US 10-year real rate and real bonds rate. Then it moved to about 100 basis points. Now it's almost 200 basis point difference. So the bond market is starting to differentiate. And these are not short-term movements. These are sort of long. We've been having a steady 170, 180 basis point differential between real bond rate and real US Treasury rate. So that you can I think that you can explain that difference, just the differences in the economy, difference in the sheer size of the fiscal policy, sheer size of the industrial policy, probably can explain that difference. So yes, I think that equilibrium real rates are higher, but it's the U.S. real rates are now just on a roll. It seems like it's gone up now with the difference of 180 basis points between Bund and Treasury real rates. But now it's U.S. Treasuries are going higher. And I think now we have moved to a new regime where technicals are just pushing it higher. So yes, equilibrium real rates have gone up. We will have eventually Fed models, etc. Will justify any number in the future with one model or another. However, it has to be higher just because of that. But the supply will be the new one, the new variable that
And
will.
actually, if you mentioned supply there, I mean, many people in the market have started to talk about how, is this the reckoning, the day of reckoning for the Fed or for the Treasury, the US Treasury? Debt levels are high, deficits large. We've had some auctions, debt auctions of the Treasury in the US over the last month or two where they haven't gone as well as expected, you could say. So, I mean, do you think that part of this rise in interest rates, like long-term interest rates in the US, is due to some concern or risk premium coming into the market around debt worries, or is that misplaced?
No, it's not misplaced. I think it is, especially we have a sort of a mini regime change last 3-4 weeks that auctions have started to tail. We're not in the US used to auctions trailing persistently one after another. We had I think that we have sort of started to saturate the demand, in terms of supplying in the 30 years, especially. We saw that in the 20-year sector as well. And one of the 10-year auction as well has a little bit of tailing happening. So it's a persistent phenomenon. I think a bunch of things has happened at the same time that needs some reckoning by the Treasury Department. One is that the QT, we had a banking problem, and then the Fed had to pause the QT a little bit, and instead it pumped. It had to buy a lot of securities from the market. So we had a mini QE from March to May, and then QT resumed. And when it resumed, it started running off more of the longer term notes and bonds, as opposed to before it was mostly bills, because the bill runoff is kind of done, and then the notes and bonds. So you got when a 10-year note runs off, it was a 10-year note originally, but when they run off, it ran off at 0 duration. And then, so you got that runoff, and 10-year, and then the Fed, and then the Treasury is supplying pretty massive volume of both bills and notes. So you don't have any demand from the Fed point of view because of the QT, and the supply is going up. So we are probably at an inflection point where 10-year has started, 10-year, 20-year, 30-year has started to go a little faster than before. And this equilibrium that we have seen so far between bonds and treasuries, or JTBs and treasuries in the long end, start to digress.
And actually, it's a valid point that you make around the regional bank crisis, where the Fed sort of de facto did QE, and so maybe we kind of mistook the stabilization or the lowering bond yields and as like, oh, the end of the bond cycle, but actually it was just QE came back, and now that QE is gone, suddenly US yields have gone back up.
Correct. And QT Now QT came back, but not in bills, but notes and bonds. So that it bites a little bit more. Yes, totally. It was a sort of confusing because we had markets. If you look at where the 10-year real rates are today, it's about it's not too far below where it was in October, November last year. So market had established where the equilibrium rate was for almost 8-9 months now. In between, we had ups and downs for lots of misleading reasons. The Japanese, a lot of confusion about BOJ yield curve control. The market was expecting a January yield curve control, but the BOJ didn't deliver that. Then we had a massive January payroll number in the US. Probably an error, but it completely put the market offside. We had the bank, some of these Silicon Valley Bank and other bank issues. So there was a lot of volatility in between. But if you look at mid-May this year and early November last year, 10-year real rates and 10-year nominal rates are about in the same place. So it was all noise. And now it was all noise, and now we are adding supply. So yes, it's a time of reckoning that, yes, supply is going to be a factor going forward.
And in terms of the strength of the US economy, what's your sense on that?
Still strong. I don't understand why it's such a surprise for the Fed, the fact that it's so strong. The hike that they have done, and if you look at the US mortgage rate last week, it was at 7.3%. The hike that it has done, the 7.3% mortgage rate should hurt the economy, hurt consumers. It's like the largest thing in a homeowner's financial statement, whether it's an income expenditure or largest thing in their balance sheet. At 7.3% mortgage rate has not affected the U.S. homeowners. There is the hikes seem to not hurt the households in the U.S. So it only hurt the firms, and so the firms are starting to. You see that in the JOLTS number this morning. The firms are starting to see margin compression. Firms will start to lay off people eventually, not maybe as much initially, but eventually the monetary policy transmission will happen through firms. But right now, the one transmission mechanism, which is through households, are not happening because homeowners are still facing 2.5% to 3.5% interest rate for the largest item on their balance sheet. And homeowners are the housing, the consumers, households at the largest part of the U.S. economy, something like 70% of the U.S. economy is consumption. So that's not changing. So
in some ways, what you're saying is that one of the most effective ways for interest rates to impact the economy isn't really working in the US because of the nature of the US mortgage market is such that people can lock into low rates for like 30 years. And so it doesn't really matter what the Fed does.
Yeah, it just doesn't matter. It matters very little or a lot less than it used to be. Not only that, the mortgage rates are not affecting the households. The households' leverage is also a lot less than the last hiking cycle. Actually, 2004, 5, 6 hiking cycle. Household debt ratio is significantly lower than it used to be. So monetary policy is not having the same effect that it had in the last serious long hiking cycle.
But presumably new entrants to the housing market would be affected. So someone entering the housing market to buy a new house would have to pay that much higher mortgage rate. So there should be some impact in purchases, presumably house purchases or construction, those sorts of sectors.
It is having effect, and these are all having misleading effects. These are change in the structure. And one of them is that with the existing homeowners are not feeling the effect of the hike, but the new potential homeowners are really affected. You look at the affordability index of U.S. homes, it's now is less affordable than even 1974 was 1994. 1993, 94 was when we're less affordable than this. So this is a serious problem because and eventually it will bite, but not in a traditional way, but in a different way. That housing construction is definitely slowing down. The liquidity of the home ownership market is going lower and lower, and liquidity is key in home ownership in the US. It's not, and then liquidity in the mortgage market is also declining. We see that in the spread between primary and secondary mortgage rates, because there is so little mortgages are created. Financial institutions are reducing the personnel, laying off a lot of people who are in the mortgage origination side of their business. And so the overall liquidity in homeownership, whether in financing or whether it's in actual home transactions, all of that are going lower. And liquidity of homeownership, either financing or homes, is key to American homeownership growth. So it will, in the long term, be very negative. And one of the misleading signals is the home builder stocks. If you look at the home builder stocks, they have performed better than the AI stocks this year in the US. And you wonder what's happening. And the story is that existing home supply has dwindled to practically zero. So new home builders will have a lot of business because the only way you can own a home is by building a new home. But if you look at the actual financials of the home builders, their revenue has gone up a lot in this year, in the first quarter and the second quarter financials. But that's because the price of new homes have gone up. The number of new homes that they're building is absolutely unchanged, actually starting to decline. So it's puzzling because you superficially look at the equity prices of home builders, it gives you a wrong impression about the state of the housing market, state of residential investments, all of that just because of some sort of a distortion that has happened through the lock-in effect. And now even the new construction in multifamily, which was growing, is also started to flatten out. So that's maybe where you might see significant labor effect on the labor market as well from the construction side. But at the same time, the CHIPS Act has triggered some construction in the manufacturing chips factories and etc. So we see some of that hiring there, but eventually it might be affected by that. But there's a lot of distortion that's happening that's keeping the consumer very strong, spending, retail sales strong, consumer credit extremely strong, consumers' ability to take car loans, credit card loans, all of that has gone up because their balance sheets are strong. So that's why U.S. economy is separating from the rest of the advanced world.
And the way you describe the housing market, it does sound like eventually these higher mortgage rates will bite because of its impact on new home buyers. So is this an issue of there's a lag? This is part of the famous, monetary policy works with lags. Is it part of that story, or do you think that the Fed will need to raise rates even more in order to have a larger impact?
Raising rates even more will not do it. Will just be put a differential. It would make this differential even bigger because the manufacturing will be hit really hard. We'll start to see small banks start to get hurt by this, and but consumer, the large scale, uh, the big part of the economy, which is the consumers, may not be hurt with higher rates. But that is exactly what Fed will do. Fed will see that the consumers are not cracking, and so Fed will come back and hike in 2024, and especially if rental inflation goes back higher and some other sectors, they still see inflation persistent. The last mile, which is between 3 to 2, could be a very slow winding process for them. So they might hike, but hike will only differentiate the economy between firms and consumers bigger, and the renters versus homeowners bigger. But there is another huge negative long run for the US economy is that the turnover of households, there's a certain minimum amount of turnover that in a healthy economy, people need to move from one state to another. There is some mobility that's consistent with a certain growing economy. And what we have done, we've frozen people in their homes. And so they reduce the mobility of the economy, which might also hurt in the long term in terms of flexibility of the labor market.
That's a great point there. Now, I did want to pivot to some other countries as well. You mentioned earlier BOJ, YCC. What are your thoughts on the BOJ?
I think BOJ, it's clear now, and Weather has saw this be more than the market has, that equilibrium for the 10-year JGB is not 1%, it's way below that. And so he was comfortable turning it from a hard target at 0.5 and moving the hard target at 1, and the market refuses to go too much from where it was before the tweet that they announced. Key is the short end. Remember, Japan still has a negative short-term interest rate, while the rest of the world has increased interest rate to positive level. So the quantitative difference in terms of the rate difference, front-end rate differential is large, but the qualitative difference is also huge and negative in Japan versus large positive elsewhere in the world. Japan is having a very large influence. And one of them is just it made for the one of the largest holder of U.S. treasuries or buyers, or generally U.S. assets, have been Japanese insurance companies, pension funds, even like big GSEs, etc. in Japan. And now all of them find it very unattractive to buy U.S. assets, just because the hedging cost is now very unattractive back into Japan. So if the biggest thing was if there is any sign that they will change the short-term interest rate from minus 0.10. And I didn't feel that they will do, but it was clear to me from where the panel discussion at Jackson Hole last weekend that there is no plan to change the front end. And if the front end doesn't change, then the drop in JGBs, forward drop in JGBs USD JGBs will remain very steep. And so hedging costs will be very large for Japanese to buy any foreign foreign bonds, especially the US. So the demand for Japanese JGBs will be quite strong. And we see that. And we see that also in the JPYs. Today we touched 147. We actually exceeded 147. We've come back a little bit now, but we did go above 147 sometime in the morning today. So the story is that I think that the one thing that Veda said that kind of clicked in my mind that maybe there will be not a significant contagion effect from China to the US, but to Japan it will still be. And we see significant, call it deflation in the export prices in China. And Japan, Korea, and Taiwan are the key export destinations, are key export destinations from China. And all three of them had significant decline, significant deflation in the export prices going into those countries. And I think Veda sees that also some transmission of deflation from China into Japan. So he is not comfortable. And there are models. In my mind, whenever somebody talks about model, they're talking about free option. Because you can tweak a inflation forecasting model in 20 different ways and they get 20 different results. But the fact that he keeps talking about it, basically, he's uncomfortable about the inflation transmission from China. He's not uncomfortable about the next 1 year, whether they will sustainably be able to stay about 2%, despite the fact that their observed inflation is now high.
And you mentioned also you mentioned China there. What's your view on China?
China is very, very interesting. What's happening? There is the economy part of it, the growth, etc., and there is the financial side of it. On the financial side, the big news is the Country Garden, and it's a shocker because Country Garden was in China the most solid financially among the developers, and really large, with projects all over China and mostly in tier 3 and tier 4 towns. I remember traveling in China and by train across and seeing the small towns and villages. You will be amazed at how many big high rises under construction that you see just from the train window, not the big cities like Shanghai and Chengdu, but the small towns. And this is where Country Garden market has been. And suddenly, they had solid financial statements until the end of last year. And suddenly, there has been a freezing since probably February. You see that in the second quarter financials, but it probably started sometime earlier, that the demand for their homes has suddenly gone down. If you remember the context of the US Chinese housing, the whole deleveraging was triggered by the central government in China, where they established in 2020 what they call 3 red lines, because the government thought that their economies to become too dependent on real estate. And so wanted to somehow clamp down on leverage in real estate. So they established some rules on leverage. And one of the three red lines did really hurt the developers. And that was that the advances they received from homeowners for apartment construction did not be used as a collateral for getting loans. So they had to establish the ratio of about the debt to assets to be less than 70%, excluding the deposits from the potential homeowners. And that used to be a key financing vehicle for the developers. So initially, it hurt. We saw Evergrande are into trouble, and there are a lot of other having not satisfied that 70% target of the three lead lines. Start to when Evergrande actually went into trouble and being in the process of being resolved. But on all these, Country Garden was with flying colors. Their customers are different. Their projects are in small cities, and that's where sudden decline in demand has frozen their revenues, and so they are not capable of paying their lenders. They can potentially they're renegotiated with their domestic lenders and also the offshore lenders. So I don't think there is a potential for contagion for U.S. subprime type contagion from these. I think there is a element of conflict between central government and local government in triggering this deleveraging, because the central government thinks or knows that the local governments are funding itself through developers, sort of like a hidden leverage. A trio of developers, local governments, and trust companies help the local government run a much bigger budget than they should have based on their known financing, known revenues. And local government can then finance infrastructure, very large infrastructure projects within their areas. So it's all government. A big part of this is government to government. The trust companies are sort of SOE, the government sort of SOE. You got the federal government, you have the local government, and developers are sort of a vehicle for local governments to sell land and get revenue for that they don't get from taxes. So so it's a lot of it is public sector allocation of debt, and there is enough capacity, the debt capacity in the central government, but there is excessive debt in the local government. So if they can find a mechanism to transfer from local government to central government, they can resolve it. So it depends on what does the central government want to do, whether to take on that debt. They have offered these swap facilities to some local governments, where local governments can swap their debt with the Chinese central governments, but it's not large scale. So we'll see. There is a lot that will happen, but our expectation of whether it will be a U.S. style big fiscal package and I think about our subprime pricing. What we did is we basically went out and bought bank shares with fiscal spending and keep the banks alive, and then basically resolved some of the banks, a lot of bank foreclosure, moratorium, et cetera, and zero interest rate for 12 years. We are expecting typical policy at this point should be a big burst of fiscal spending, basically to get the homeowners back, homeowners' demand for housing back. That's not happening. Yeah, we're seeing quick here and there, but that's not happening. And I don't think it's necessarily an oversight, because China has been well known to let a sector die without doing anything. They've done it to the remote education sector. They've done a lot to the consumer, a lot of the technology platform companies. So it wouldn't surprise me if they let the real estate sector at least leverage decline, or the leverage to be more explicit rather than all this convoluted.
So the upshot essentially is a much slower China from a growth perspective, no contagion necessarily to the rest of the world, and sort of low inflation, deflationary dynamics within China that could impact the Northern Asian economies, the Northern Asian economies.
I think that there will still be effect on inflation in Japan and Korea and potentially Taiwan as well, but that not necessarily the real sector in the economy. But China, we still have most forecasts around 5%. There's few street houses have lowered it below 4%, below 5%, but it's not 3% or 4% yet.
Yeah.
So, but it's yet to be seen, this frozen demand for apartments that has been happening for the last 3 months. Whether that is intentional, whether that is going to persist for a while, is yet to be seen.
Yeah. And if we round off with some of your positioning, how you're positioning these markets, your trades, I mean, how, as an investor, or when you speak to investors, I know you speak to lots of sort of the top macro people in the world. I mean, what are you saying in terms of how to position in this regime?
The big position should be the differentiation between the US and the rest of the world. US is a different animal. It has a consumer leverage is significantly lower than it used to be. So what we are used to about US households is very different from today's US household. Not only that the monetary policy is not working on them, they also have very strong balance sheet to the asset side as well. So despite historic highs, US households are strong and will remain very strong, while other central banks having to somewhat follow the US in terms of monetary policy has a totally different household balance sheet. And so they hurt their economy in a very big way to catch up with the US. And UK, you got Eurozone, the same thing. We're going to see, if you look at Eurozone real rate, let's say bonds, 10-year real rate is still around 0, where US is almost 2%. So, and that difference is now big and will be bigger. So a lot of our trades are related to that. Bond treasury yield spread widening. We think
so you go short US rates, long bonds, or long
bonds.
Yeah, or JGBs
against that,
or gilts or something. So basically, you're playing for higher US yields versus Europe or even Asia. So sort of
correct
rate divergence.
Because Europe doesn't have any significant capacity to raise rates after a 1 or 2, and then they will have to stop. Fed doesn't have to stop. In 2024, if they find inflation still robust, they can come and do another 200 without any problem. So and the same with Japan. So we will see that divergence trade become big and a driving one. And then divergence trade has related trade, like volatility is coming back in the long end of the curve. Then it was kind of dead before, and now we see implied vols. The realized vols actually are much higher now in 10-year rate and the forwards, 5-year forward, 5-year rates. Then in a while, during this whole zero rate policy, the long rates have been very, very low volatility. But now volatility is coming back in that sector. So long optionality in 5-year, 5-year, 3-year, 5-year, 3-year, 10-year. We like it a lot as a large sort of thematic trade in the US. And not clear whether the same applies in Europe. And the other is that we still have some pricing of cuts for next year. The chance of that actually happening is, in my mind, minuscule. And so the market, there is still positive carry to 1 year, or positive carry in 2 years, being short the 2 year. The market should keep doing that. And there's that 2 year has sold off a lot. Now 2-year real rate is about 3.2%, which is just unbelievable, like how much it has sold off. But there is room for way more sell-off as well, just as the cuts get priced out of the yield curve. So a lot of yield curve trades out there. I'm not sure the US equity had done really well because the economy, initially it was AI and et cetera, but now it's across the whole spectrum of equities within even like Russell 2000, which is the smaller companies are starting to go higher. Some of it is maybe that the consumers still have a lot of wealth that they can still buy through their pension funds, through 401k, etc. And so index buyers, motivated by all the AI related rally now, as the index buyers are in, the bid for all the other equities have gone up a lot. But if the supply in the long end of the treasuries remain robust like that and start to have a significant effect in the long end treasuries, then I think it will slow down the equity markets at some point, at some level of treasuries. And I think that 10-year probably can easily go to 4.5 from here. So still room for being short there.
Yeah. Okay, that's great. It's very clear. I did want to round off with just a personal question, like I like to ask all my guests. I love reading books. Have you read any good books of late?
Yeah, one, it's not related to the bond market or any markets, but I just finished the book. It's called the Bengali Marlin. It's written by Vivek Bal. It's about the experience of immigrants from Indian subcontinent coming in the late 1800s to the US. And there was a flow of immigrants to the US from the Indian subcontinent in the 1800s. There's not much written history about it. And this topic always interests me a lot. Some of this, I often, when I travel in countries, I talk to people from different places and ask them about what was their journey in Italy, from the people from Bangladesh who traveled, walked across Albania and the rugged territories to come to Italy, or people who took boats across the Mediterranean to get to Italy, Portugal, the US, crossing the Darien Gap, crossing across Mexico to get here. This drive amazes me, that how much drive these people have to get to places where they have opportunities. And this story is about these people coming from South Asia. And this book catalogs individual stories in cargo ships from places in Calcutta or Bombay and arriving in New York. Their experience was just fascinating to me. In those days, you grow up in some village out there, and then suddenly you decide you will go so far away. So there was the story of the drives coming to the US, then going to the Atlantic City, New Orleans, Philadelphia in the 1800s, starting business there. It's just amazing stories. The book catalogs some of these stories. One of them was just fascinating to me. There was a gentleman who's from 1880 or 1870. He came from a coastal village in Bangladesh, in British India in those days, went to Calcutta, boarded a ship with a basket, a trunk full of trinkets that he hoped to sell, came on a ship via South Africa to New York. And when he was at Ellis Island, the immigration officer didn't like him, so he was put back on the ship. And he then went back to, instead of going back to India, he went back to South Africa in Cape Town. He sold his trinkets in Cape Town, then hopped on another ship to come back to New York. And I'm talking about 1800s, when there was no airplanes. And I came back to New York. And this second time he made it. So the persistent story of immigrants' journey and persistence is just amazing. And that's it. It's by Vivek Bal. It's a book called Bengali Marlin.
It sounds great. I mean, I've never heard of the book before. Sounds fascinating. So I'll make sure I'll read that one. And I imagine other listeners will want to read it too. Now, finally, what's the best way for people to follow your views?
I think tweet. I tweet on and off, often actually. And we have the Macro Hive weekly and Macro Hive pieces. Macro Hive website is another place to follow. And also in Twitter. Yeah.
Or X, or I don't know how to call it now. Twitter X or whatever it is. Well,
confusing.
With that, thanks a lot, Mustafa. That was really, really helpful. A great tour of the world and a tour of markets. And look forward to continuing to follow your work.
Great, Bilal.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or if you listen to podcasts, leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.